Welcome to Morning Brief, presented by Robinhood, the home to commission-free trading. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the Federal Reserve will issue its all-important rate decision this week. The central bank widely expected to cut rates at its meeting, but the Fed is still concerned about persistent inflation, adding uncertainty to its path forward. Bets on a December rate cut have helped boost investor sentiment recently, but there is still some concerns over AI valuations and circular financing. Oracle and Broadcom results this week will offer a fresh read on the state of artificial intelligence. Plus, Netflix could be facing regulatory hurdles in its $72 billion bid for Warner Brothers. Over the weekend, President Trump said the acquisition could be a problem. The president told reporters the merger would give Netflix a lot of market share and he will be involved in the decision. Trump also confirmed he met with Netflix co-CEO Ted Sarandos at the White House. The visit echoed strategies of other CEOs who have met with the president as they seek various deals. And Warren Buffett's Berkshire Hathaway is losing a key executive. Todd Combs, who oversees Berkshire's investments and serves as Geico's CEO, is departing for JPMorgan. Buffett announced the exit this morning and said JPMorgan made a good decision in hiring Combs. He has been with Berkshire since 2010, and he'll join JPMorgan as the bank's new head of security and resiliency. Combs will also serve as a special advisor to CEO Jamie Dimon. Let's get a check-in on stock futures here on this Monday morning. Looks like we've got indications for a higher open, albeit a modest one. The Dow indicating the smallest gain of the three major averages. The Nasdaq looks like it could show the largest. Let's dig into our top stories of the day. Stocks a little changed as investors await key earnings. Plus, the Fed expected to cut rates by a quarter point this week. And Berkshire Hathaway's investment manager leaving for JPMorgan. Joining me now, markets and data editor Jared Blickery, Federal Reserve correspondent Jennifer Schonberger, and our head of news, Miles Udland. Jared, I want to start with you in the setup here this morning, which is quiet for the moment. But as we've been talking about, we got a lot going on this week.
Yes, we do. And then things are going to get pretty quiet. So let's take a look at the Wi-Fi Interactive behind me. You can see around the world kind of a mixed picture, but not a lot of outliers here. One thing I've kept my eye on is the Russell 2000. Now, these are the futures, and you can see they're up 0.2% overnight. But here's the year-to-date chart, and you can see that they have just broken to the upside here. Is this going to be another false breakout to the upside that gets up the hopes of the bulls, only to be kind of smashed by negative price action? We'll have to see, but that's been the playbook over the last few years. Meanwhile, mega caps have really perked up here. Before I get into that, I want to check in on the bond market. This is a 13-week T-bill yield. This closely tracks what the Fed is up to. Over the last 10 days, it is down. It's up 2 basis points right now, but traders have been pricing in a rate cut later this week. We'll get that decision Wednesday, of course. And now let's take a look at the longer end, because that's been creeping up. Here's the 10-year T-note yield. It's up another basis point overnight to 4.15%. And over the last 10 days, it's been trending to the upside. Here is the year-to-date on that. And you can see it's still kind of holding by the lows of the year. And then here's the 30-year. I thought this was interesting because it's just poking its head above a key technical level. That is the 200-day moving average. That's that blue line that just appeared there. Nevertheless, it's not in a territory where it's caused problems for stocks before. That would be above 5%. And then it's been somewhat quiet. You take a look at the ICE B of A Move Index, which is like the VIX for the bond market. That is near the lows of the year. That's good for stocks because that is showing that there's not a lot of worry in bonds that could leak over into stocks. And for that matter, the VIX, here's the year-to-date of the VIX. That's by the lows of the year too. So there's a bit of complacency in the market, but we expect that this time of year. That's a good thing because volatility and volumes are supposed to drop into year end, especially after we digest this big Fed announcement this week. Here, real quick, here's the sector action. This is what happened Friday. We can see the three mega cap sectors were leading. Here's what's happening today. Tech is up 55 basis points. That's that value in the little rectangle there, followed by utilities and industrials. And we can talk about some of the companies. We got some big earnings this week as well, Julie.
Yeah, let's talk about those. We're talking about Oracle and Broadcom. And Oracle has sort of, as there have been some questions about the AI trade among large cap tech, the questions have sort of centered around Oracle, so that's going to be an interesting one.
Yeah, let's take a look at the Wi-Fi Interactive. Here I have Oracle, that's in purple, versus iShares software ETF. So that's kind of just like a broad industry gauge of software. And that's this little cyan line down here. You can see it hasn't done much this year to date. It's up about 9%. Here's Oracle, it's up 30%, but check this out. It used to be much higher, and it's just been very volatile. Here's that spurt where they were doing deals, and then there was kind of the rubber meets the road moment where a lot of Wall Street is waking up to the fact that there's going to be a ton of capex, a lot of spending that's required in this AI trade, and Oracle is very exposed because they don't have the cash on hand of the hyperscalers. They're not a cash machine like Alphabet is or Microsoft is, and so you take a look over the last 2 months, Oracle is down 24%. So Oracle is my canary. This is a big kind of canary in the coal mine potentially for the AI trade, how we set up for next year. Then we have Broadcom, and that's just been a stellar trade this year. You can see over the last 2 months, down about 2.78%. Let's check out a year to date. And I was looking for Broadcom versus NVIDIA. So it looks like we're just looking at NVIDIA. Let's try Broadcom versus semis. There we go. Here, Broadcom is up 68%, and the Philly Semiconductor Index up 47%. Now that's a huge amount, but Broadcom is even outperforming that. So, I mean, we look at the NASDAQ 100 heat map every day. Broadcom is right up there. You can call it the Mag 8. I would definitely put them on your list to watch this week as well, but everything looks pretty good for them. Price to perfection, maybe a little bit, but it would take a big disappointment, I think, to knock the wind out of its sails.
Yes, and of course the other big thing that we are watching this week is the Federal Reserve. Jen, I mean, everybody's expecting them to cut rates, it seems like at this point.
Yeah, good morning, Julie. It is likely that the Fed will cut rates for the third time this year on Wednesday. Investors pricing in a 90% chance that the Fed will cut, a prospect that didn't seem so certain, if you will, just a couple weeks ago, just because there has been so much division within the FOMC over whether to cut rates further, given that inflation has been sort of stalled a full percentage point above the Fed's 2% goal. And as a result of that, I do expect that we could see anywhere from 1 to 5 dissents on Wednesday. We could see the contingent of regional Fed Bank President Hawks, from Boston Fed President Susan Collins to Kansas City Fed President Jeff Schmid, St. Louis Fed President Alberto Musalem, and Chicago Fed President Austin Goolsbee. They all have the potential to dissent because they have voiced concerns about inflation being sticky. We certainly know that Jeff Schmid dissented last meeting, so there's probably nothing that's really changed at this point in his view to stop him from dissenting again on Wednesday. But then on the flip side, we have Fed Governor Stephen Miron, who has repeatedly voted to cut rates by 50 basis points instead of the 25 basis point rate cut that we expect on Wednesday, because he believes we're not seeing any inflation from tariffs, and he believes that housing prices are coming down, and that is soon going to be reflected in overall inflation measures. So I would expect him to dissent on the flip side, on the downside, because he would prefer to cut by 50 basis points. And, you know, as far as the path next year, because we are going to get interest rate projections for 2026, I think that is going to look hawkish as well. Officials had penciled in only 1 rate cut for next year. Maybe we get 2, but I think that we're going to see a lot of restraint from Fed Chair Jay Powell, similar to what we saw in the last press conference, that rate cuts going forward, perhaps not a foregone conclusion. The Fed really watching inflation here versus the job side of their dual mandate.
Yeah, definitely. And Miles, we got to get to you and what's going on with Berkshire Hathaway here this morning. You know, as we enter a new phase for the company, it's going to be a new phase in more ways than just Warren Buffett not being involved in the day-to-day anymore.
Yeah, I mean, obviously the headline this morning is that Todd Combs, the top stock picker, Berkshire Hathaway, leaving for an interesting job at JPMorgan. I know David Hollerith is doing some reporting on that, so maybe we have some more color on the JP side of it later today. But I think my takeaway was 2 parts this morning. The first, it's like, oh, it's starting December 8th. And Warren Buffett's done at the end of the year when he announced in May that he was going to recommend to the board that he be succeeded by Greg Abel at the beginning of 2026. It felt a little abstract. It's like, it's 7 months away. Don't really worry about that. But it is here, and there are only 3.5 more weeks until Warren Buffett will no longer be the CEO of Berkshire Hathaway. And as a result of that, we are starting to see the shape that Berkshire Hathaway will take, at least in the initial days of Greg Abel's tenure. And I think what's interesting about these moves is not that there's household names now running Geico, and now they have a consumer products division, and now they have a general counsel in-house for the first time. Of course, that general counsel comes from Munger, Tolles & Olson, which is the former law firm of Charlie Munger, Ron Olson, longtime member of Berkshire's board as well, a partner at that firm. But it's just that Greg Abel's not going to sit there and say, yeah, I'll just take the seat and everybody keep doing what they're doing. Like he's going to find ways to make his imprint on the firm, which any CEO does, but no other CEO has ever taken over from Warren Buffett. So to see Abel take what I would call like a traditional tactic, right? Of I'm going to get some people, we're going to make some structural changes, we're going to look a little bit different in this new era. To see Abel start to do that, and I know Buffett's in the press release today, but to see those two work together to reshape the firm before Greg gets in that seat next month is interesting, and I think a signal that they don't want investors to view this as Warren Buffett's company with a new guy running it. Right? They want investors to view this as Greg Abel's company. And of course, Berkshire is one of the 10 largest companies in the market. So it's not like you have a ton of slack in terms of, your decisions won't make an impact, this, that, or the other. Like these are important decisions for a major company. So I think it's very interesting to watch those, watch these changes roll out in advance of Greg Abel's tenure. And I get the sense there's going to be more changes, more things that feel Greg-like, and we're going to stop talking about like what would Warren do pretty quickly.
Yeah, really interesting. And your point is really well taken that this feels like the beginning of the rest, right? It's not just that, these are the changes he's making and that's it. So we look forward to continuing to talk about all of that. Thank you guys so much, Jared, Jennifer, and Miles. We got to get some breaking news right now. Paramount, it's not done. Paramount has upped its bid now for Warner Brothers and is now offering all cash at $30 a share, a bid that it says is superior to Netflix's bid for the streaming and studios part of Warner Brothers. Now, in the statement, Paramount says that this deal represents an enterprise value, that's the total value, including debt and equity, of just over $108 billion. That's what this acquisition would represent. It says it's comparing that to about $82.7 billion, excluding the spun-off company. So it's not quite an apples-to-apples comparison, but clearly Paramount is still lobbying hard to get this deal done and also stepping in and perhaps trying to take the opportunity, given that we had President Trump saying over the weekend that there would be a lot of scrutiny at the very least of Netflix's acquisition of that part of Warner Brothers. As part of this also, it looks like there's going to be a decent amount of debt as part of this acquisition offer, $54 billion of debt as part of this total bid. So large part of debt as part of this. We definitely heard a lot of reaction to the Netflix acquisition of the streaming and studio assets of Warner Brothers over the weekend, and not just from the president, but from others in Hollywood, some of whom expressed trepidation about the effect that this would have on movie making in the center of movie making. So still a lot to talk about for this, and we're going to continue to talk about it, by the way, coming up later in the show to get more of a take on what happens now in this ongoing story. In the meantime, we'll be right back with some of your trending tickers and get you ready for the opening bell on Wall Street. Welcome back to Morning Brief, presented by Robinhood. Now time for some of today's trending tickers. We are watching IBM, Netflix, and Tesla. First up, IBM will buy Confluent for $9.3 billion. That takeover one of IBM's largest ever. Confluent is a data streaming platform that allows companies to gather and analyze data in real time. For IBM, it's a major bet on the kind of enterprise software that artificial intelligence tools need to perform tasks in real time. The acquisition builds on a 5-year partnership between the two firms, which allowed some IBM customers to use Confluent's data streaming platform. Both of those stocks trading higher, IBM just slightly. Next is Netflix. The streaming giant is facing regulatory hurdles in its bid for Warner Brothers. It's also facing Increasing competition. As we just learned, Paramount just increased its bid for the studio to $30 per share in cash. And over the weekend, President Trump said the size of Netflix's market share could pose a problem. We are going to keep following these headlines as they cross fast and furious here. WBD shares are now higher by 6% following that upped Paramount bid. And finally, Tesla, those shares are sliding after Morgan Stanley downgraded the stock on valuation concerns. That downgrade comes as a new analyst at the firm assumes coverage of Tesla from longtime analyst Adam Jonas. Remember, he moved into a different role at Morgan Stanley. The firm set the stock's new price target at $425 per share, which is below where it is right now. After several years of outpacing the S&P 500, the dominance of the so-called Magnificent Seven stocks may be fading. Longtime bull Ed Yardeni is now effectively underweight the Mag 7, ending a 15-year bet on big tech. I want to bring in Gina Martin-Adams, HB Wealth Chief Market Strategist, here with me in the studio. I'm so excited to have her here. We were longtime colleagues as well at Bloomberg, so
Absolutely.
It's good to see you, Gina.
Thank you. So glad to be here.
And I know this is something that you're watching really closely as well, as most people in the market are, right? The sort of gap between Mag 7 and everything else, not just from a valuation perspective, but from an earnings power perspective.
Yeah.
So what happens in 2026 to that relationship?
Well, it's going to be really interesting because if the analyst consensus is correct, and that is maybe a big if, but nonetheless, we'll go with that, we should start to see the gap between the Mag 7 and the rest of the equity market start to close. We should start to see this enormous earnings power wane somewhat. And this has actually been happening a little bit behind the scenes. 2024 was peak Mag 7 earnings growth, peak tech earnings growth. In fact, that earnings growth slowed a touch into 2025. But because we had so much uncertainty emerge with respect to tariffs, where were interest rates going, slow economic conditions, the rest of the index really didn't put up much earnings acceleration. That's expected to change in 2026. The analyst consensus is thinking, look, the Fed's going to reduce interest rates. We're going to get some tax refunds coming in 2026. Maybe we'll have a little bit of stability emerge on the trade front, and the rest of the index can create some earnings growth. If that gap starts to close, we might start to see some rotation into those non-tech stocks. And indeed, that's what we've seen over the course of the last 4 to 6 weeks, is the non-tech stocks getting a little bit of attention, while tech stocks, in particular the Mag 7, lose a little bit of the market's mind.
So do you agree then that it's time to effectively underweight the Mag 7, or at least rebalance away from it a little bit?
I think what you're seeing, frankly, is a little bit of dispersion start to emerge in the Mag 7. There are winners and losers emerging. There are good reasons to anticipate that that's likely to be the case going into 2026. It's no longer one big trade. It's no longer sort of the pocket of strength that all investors can rely on. As more opportunities emerge and maybe some disturbances start to emerge in the Mag 7. Certainly the AI trade has been all the rage over the course of the last several years in the equity market, really powering this enormous valuation gap as well as an earnings gap. As that closes, the winners and losers should come to light. Not everybody's going to be a winner in AI. Right? We're going to find out who the leadership probably is into 2026. One of the things that nobody's talking about also, though, is we might start to see IPOs emerge. 2 of the world's biggest private companies are AI operators as well, with Anthropic and OpenAI. There's been these rumors of OpenAI maybe coming to the market in 2026 into 2027. That's going to create some opportunities for public equity investors as well, which have really been trapped in few names that they can play on the AI idea. So if we have more options of supply, that could create some disturbance, if you will, in the Mag 7 force.
Well, and I think the other point that Ed Yardeni makes is that the benefits of AI will accrue more broadly.
Yeah.
Right? So you don't need to buy an AI I mean, that's already happening to some extent with other types of infrastructure names like energy, like industrial. But in theory, at least, if companies are able to save money because of AI, you should be able to see the benefits.
Absolutely. And you'll see that play out through operating margin expansion, hopefully. If we get the productivity gains in the broader economy as a result of AI deployment, not just AI build, you'll see the users of AI start to experience some benefit. I think that might not be until 2027, but the market could trade on that in 2026. A lot of this is going to depend upon how companies deploy and utilize AI, and we're still in the very early stages of figuring out if that's a massive productivity enhancer or not. But by 2027, we really should start to see this stand up some operating margin expansion for the non-tech users in the index. This could be a magnificent benefit, frankly, and something that we need to watch pretty carefully because over 20 years, very little operating margin expansion has occurred outside of technology, inside the S&P 500. If we can get some productivity growth, some operating margin expansion, greater efficiency gains through AI in those non-tech segments in the market, you could see a much greater improvement in valuations outside of the tech space where all of the optimism in the market has really been concentrated.
You know, it's so interesting. We talk so much about AI, but of course, the bulk of the U.S. economy is made up of consumer spending.
Yeah.
It's not enterprise spending as much as we talk about it. And the consumer has been uneven, as we've talked a lot about, K-shaped economy, et cetera. There's been some optimism about next year and the benefits of the tax bill.
Yeah.
But I get the sense you're not as optimistic about the consumer.
Yeah, I think the consumer, frankly, is facing a lot of constraints. The biggest one is the fact that the unemployment rate has been rising for 2 years. This is something that generally has never happened outside of recession in the U.S. economy. To see the unemployment rate rise for 2 years, to see the consumer sort of slow down outside of recession is pretty abnormal. Luckily for equity investors, the consumer is a smaller and smaller and smaller portion of sort of earnings realities. Unfortunately for the economy, it's still a big portion of broader economic conditions. Unfortunately, it just looks like we're not going to get a huge benefit for the consumer. And the reason I say that is because the traditional relationship between Fed funds and interest rates and borrowing conditions and consumer spending is somewhat broken. The consumer constraints are not necessarily that they can't get access to capital, it's that they're facing higher inflation and they're facing very constrained supply of goods across the board, but in particular housing. That's creating some constraints on consumer spending that are not necessarily going to go away just because the Fed tweaks the interest rate a few points. We've seen this occur over the course of the last year. Remember, in 2024, the Fed reduced interest rates as well. Consumer discretionary earnings fell every quarter in 2025, year over year. So the consumer saw basically no net benefit from that reduction in interest rates to the point where it would at least improve the earnings outlook and the consumer stocks outlook. That may very well continue to be the case into 2026. I think from a rotation perspective, there are opportunities in the index, but I wouldn't necessarily hug the consumer ideas as those best opportunities. Instead, it looks like healthcare stocks, for example, are starting to break out. Financials and industrials doing slightly better over the course of the last several weeks. Value stocks suddenly coming to life. So there are opportunities in the index. I don't know that I would go all in on a big, robust U.S. consumer recovery just yet.
Interesting. Gina, great to see you. Thanks
Great
so
to
much
see
for
you
coming
too.
in. All right, coming up on Yahoo Finance's opening bid, our executive editor, Brian Sazi, the host of that program, is here with us now. Saz, what are you going to be talking about today?
Julie, I know you want me to talk about the Fed meeting, but I got to push that aside for a second. I'm not saying it's not important, but we have a bidding war for Warner Brothers. Paramount swooping in there, like you were reporting early this morning, taking the fight to Netflix. Julie, how can you not get excited about this? Year-end takeover battle. Love this stuff.
Oh, I'm excited.
Fired up.
And we're going to be talking about it, too, later on in Market Catalyst also. So there's lots of
Larry Ellison, he's worth $270 billion? It's a bottomless checkbook, Julie.
Well, but they're still taking on debt to get the deal done. So
Yeah.
he's not fronting.
Well, he's creative. You get wealthy by being creative, Julie.
There you go. All right, that does it for Morning Brief presented by Robinhood. Much more ahead on Yahoo Finance.